You're scrolling through your investment portfolio, watching the same old blue-chip stocks barely move, when suddenly you stumble upon a company that top Wall Street analysts are calling the most undervalued opportunity of 2025. While everyone else is chasing the same overpriced tech giants, there's a hidden gem trading under $10 that experts believe could surge by 50% in the coming months. What if I told you that one of the most respected research firms on Wall Street just issued their most bullish recommendation in years, and the stock they're targeting is still flying completely under the radar? Today, I'm going to reveal exactly what this company does, why the smartest money on Wall Street is betting big on it, and most importantly, how you could potentially position yourself before the rest of the market catches on. But here's the catch: this window of opportunity won't stay open forever, and by the end of this video, you'll understand exactly why timing matters so much right now. Let me start by painting a picture of the digital landscape we're living in today. Every single day, billions of people around the world open their browsers, scroll through news articles, check their favorite blogs, and consume content from thousands of different websites. But have you ever stopped to think about how these websites actually make money? Sure, some have subscription models, but the vast majority rely on advertising and content recommendation systems to generate revenue. This is where our mystery company comes into play, and trust me, what they've built is absolutely fascinating. They've created a sophisticated artificial intelligence-powered platform that connects content creators with audiences in ways that feel natural and engaging, not intrusive or annoying like traditional banner ads. Think about the last time you finished reading an article online and saw those suggested links at the bottom saying, "You might also like," or "recommended for you." That's not random. That's the work of advanced algorithms analyzing your behavior, understanding your interests, and serving you content that's genuinely relevant to what you care about. This technology has become absolutely essential to how the modern internet operates, and the company we're discussing today has positioned itself as one of the dominant players in this massive industry. They work with over 9,000 publishers worldwide, meaning when you're reading content on major news sites, entertainment platforms, or specialized blogs, there's a very good chance you're interacting with their technology without even realizing it. Now here's where it gets really interesting from an investment perspective. This isn't some startup burning through cash with no clear path to profitability. This is a company that has systematically built a real, sustainable business model with actual revenue and improving margins. In their most recent quarterly results, they generated $48 million in adjusted EBITDA with margins exceeding 27%. Let that sink in for a moment. They're not just growing revenue, they're doing it efficiently and profitably, which is exactly what investors should be looking for in this market environment. But what really caught my attention, and what has Wall Street analysts extremely excited, is their aggressive share buyback program. Over the course of this year, management has repurchased 14% of their outstanding shares, which demonstrates two critical things. First, they're generating enough cash to return value to shareholders, and second, management believes their own stock is significantly undervalued at current prices. The company has also developed something they call the Realize platform, and this is where the future growth story really accelerates. This platform uses cutting-edge artificial intelligence to help advertisers optimize their campaigns in real time, learning what works and what doesn't, then automatically adjusting to maximize results. The company has also developed something they call the Realize platform, and this is where the future growth story really accelerates. This platform uses cutting-edge artificial intelligence to help advertisers optimize their campaigns in real time, learning what works and what doesn't, then automatically adjusting to maximize results. This tells us that not only are they attracting more clients, but existing clients are spending more money because they're seeing real, measurable results from the platform. When you have a technology that demonstrably increases return on investment for your customers, you have pricing power and sticky relationships that competitors can't easily disrupt. What makes this opportunity even more compelling is the massive misunderstanding in the market about this company's position in the evolving digital advertising landscape. Many investors have been worried about how artificial intelligence and changes to search engines might impact traditional digital advertising businesses. There's been fear that as Google and other tech giants integrate AI directly into search results, companies that rely on content recommendation might suffer. But here's what the bears are missing, and this is crucial. This company isn't competing with AI, they're leveraging it. They've integrated advanced artificial intelligence directly into their marketing platform, and they've built a network of partnerships that would take competitors years to replicate. While others see disruption, the smartest analysts on Wall Street see adaptation and opportunity. This brings me to the analyst firm that has everyone talking right now. Rosenblatt Securities, one of the most respected research houses covering technology and digital media companies, just issued a buy rating with a price target that shocked the investment community. We're talking about a firm with a proven track record of identifying undervalued opportunities before the broader market catches on. Their research teams spend thousands of hours analyzing business models, meeting with management teams, studying competitive dynamics, and building detailed financial models. They don't issue buy ratings lightly, especially not with price targets that imply massive upside potential. When Rosenblatt puts their reputation on the line with a call this aggressive, smart investors pay attention. What exactly did Rosenblatt say that has everyone so excited? They argued that the market has fundamentally mischaracterized this company as a secular loser in the age of AI-powered search, when in reality, it's emerging as a leader in AI-driven marketing. Their analysts believe that the company's technology, partnerships, and market position are being dramatically undervalued by Mr. Market right now. The price target they published represents approximately 50% upside from current levels. Let me repeat that, 50% potential gains according to one of Wall Street's most credible research firms. That's not some penny stock promoter making wild claims. That's serious institutional research backing up their conviction with detailed analysis. But Rosenblatt isn't alone in their bullish outlook. B. Riley Securities recently raised their price target on the stock as well, citing improving fundamentals and strong execution by management. Needham's Laura Martin, who is known for her deep expertise in digital media companies, has also maintained a positive outlook with significant upside projections. When you see multiple sophisticated research firms independently arriving at similar conclusions, that's when you need to sit up and pay attention. The overall consensus among analysts covering this stock right now is strong buy, with an average rating of 8.3 out of 10. Out of 12 Wall Street analysts providing recommendations, for rated a buy, 2 have it at hold, and 0, that's right, 0 analysts recommend selling. This kind of unanimously positive sentiment is rare and usually precedes significant price appreciation. Now I know what you're thinking. If this opportunity is so obvious, why hasn't the stock already taken off? This is actually one of the most important concepts in investing that separates successful investors from everyone else. Markets are not perfectly efficient, especially in smaller companies that don't get the same level of attention as mega-cap tech stocks. This particular company has a market capitalization that flies under the radar of many large institutional investors who have minimum size requirements for their positions. It's also been caught up in broader sector rotations and macro concerns that have nothing to do with its actual business fundamentals. These temporary dislocations create exactly the kind of opportunities that patient, informed investors can exploit. The analysts at Rosenblatt and other firms have done the deep work to understand the real value here, and they're essentially telling anyone who will listen that the current price represents a major disconnect from underlying business quality. Let's talk about the risks because no investment is without them, and I want you to make informed decisions. The stock has shown significant volatility over the past year, with 12 separate instances of moves greater than 5% in a single session. If you're the type of investor who checks your portfolio every hour and panics at short-term fluctuations, this might not be the right opportunity for you. The digital advertising industry is also competitive and constantly evolving, which means the company needs to continue innovating and adapting to maintain its market position. There's execution risk around the scaling of their Realize platform, and any stumbles in product development or customer acquisition could impact the investment thesis. Additionally, broader economic conditions and advertising spending trends could affect results in the near term. These are real considerations that you need to weigh against the potential upside. However, what gives me confidence despite these risks is the combination of improving fundamentals, strong cash generation, management's commitment to returning value through buybacks, and most importantly, the endorsement from multiple credible Wall Street research firms who have done exhaustive due diligence. The company I've been describing throughout this entire video, the one that Rosenblatt Securities just called their most bullish recommendation, the one trading around $4 with a $6 price target, is Taboola, ticker symbol TBLA. This is the company that powers content recommendation for thousands of publishers, that's integrating AI into digital marketing, and that Wall Street's smartest analysts believe could surge 50% from current levels. So what should you do with this information? First, do your own research. Watch Taboola's investor presentations, read their quarterly earnings reports, understand their business model deeply before making any investment decisions. Second, consider your own risk tolerance and investment timeline. This is not a get-rich-quick scheme. It's a calculated bet based on fundamental analysis and expert projections that could take months or even years to fully play out. Third, if you do decide to invest, think about position sizing carefully. Even the best investment ideas can be wrong, so never bet more than you can afford to lose. And finally, stay informed about the company's progress by following their quarterly results and any updates from the analyst community. The opportunity is here right now, but markets move fast and windows close quickly. If Rosenblatt's analysis proves correct and Taboola does reach that $6 price target, early investors could see their capital grow by 50%. That's the kind of return that can meaningfully impact your portfolio and accelerate your path to financial independence. The question is, will you be one of the informed investors who recognize this opportunity early? Or will you be reading about it in a year, wishing you had acted when you had the chance?